Understanding market dynamics, the forces at play in the economy. Market dynamics play a crucial role in shaping prices and influencing the behaviors of producers and consumers within an economy. These forces establish pricing signals resulting from fluctuations in supply and demand for various products and services. Understanding these dynamics is essential for businesses, policymakers, and economists alike, as they can significantly impact economic growth and stability. Key takeaways. Market dynamics, the forces that impact pricing and the behavior of producers and consumers. Supply and demand relationship, the foundation of market dynamics, where changes create fluctuations in price. Economic theories, supply-side economics emphasizes production, while demand-side economics focuses on consumer demand for economic growth. Price elasticity, a measure of consumer sensitivity to price changes, which helps predict market behavior. Market structures, varying degrees of competition that shape firm behavior and pricing strategies. Seasonality, recurring patterns that influence economic activity based on time. Understanding supply and demand. The principles of supply and demand are foundational to market dynamics. Supply refers to the quantity of a good that producers are willing to sell, while demand indicates how much consumers are willing to purchase at various prices. The interaction between these two forces determines the market price and quantity sold, often represented graphically by supply and demand curves. Supply curve typically slopes upward, indicating that producers are inclined to supply more as prices rise. Demand curve slopes downward, demonstrating that consumers tend to buy less of a product as prices increase. Market equilibrium, this is the point where the supply and demand curves intersect, indicating the price at which the market clears. Understanding market dynamics. Market dynamics can lead to shifts in the supply and demand curves due to various factors, including changes in consumer preferences, technological advancements, or government policies. Because of their fluctuating nature, policymakers often analyze these dynamics to make informed decisions regarding economic interventions, such as adjusting taxes or spending. Supply-side versus demand-side economics. Economic growth can be understood through two primary approaches. 1. Supply-side economics, popularized by U.S. President Ronald Reagan. This perspective champions the idea that lower taxes and deregulation can incentivize production. It posits that increasing production will result in economic benefits that filter down through society. 2. Demand-side economics. This approach argues that stimulating consumer demand through government spending or tax cuts leads to economic growth. Demand-side economists assert that a robust consumer base drives business expansion and employment. Market dynamics and price elasticity. Price elasticity of demand is another essential concept in understanding market dynamics. This measures how sensitive the demand for a product is to price changes. Elastic demand. In this scenario, consumers significantly change their purchasing behavior in response to price fluctuations. Luxury goods often exhibit elastic demand. Inelastic demand. Essential goods, such as medications, usually have inelastic demand. Consumers will buy relatively the same amount regardless of price. Understanding elasticity helps businesses forecast consumer behavior and adjust pricing strategies accordingly. Market structure and competition. The degree of competition within a market significantly impacts market dynamics. Markets are categorized into perfect competition. Many sellers offer identical products, which leads to uniform pricing dictated by supply and demand. Monopolistic competition. Many sellers offer products that are differentiated from one another, allowing for some pricing power. Oligopoly. A few firms dominate the market, often leading to collaborative pricing strategies. Monopoly. A single seller controls the market, resulting in significant pricing power. Each market structure influences how firms behave, set prices, and innovate, ultimately affecting consumers and the overall economic environment. The role of seasonality in market dynamics. Seasonality refers to periodic fluctuations in economic activity often linked to seasonal changes, holidays, or cultural events. Businesses often adjust strategies based on anticipated seasonal patterns. For example, retailers ramp up inventory and marketing efforts during holiday seasons to capitalize on increased consumer spending. Understanding seasonal trends enhances inventory management and maximizes sales potential. Real-world example of market dynamics. A compelling illustration of market dynamics can be seen in the renewable energy sector. Initially, renewable energy technologies were limited, but as costs fell and government policies encouraged adoption, market dynamics shifted dramatically. Traditional energy companies were forced to adapt to a rapidly changing landscape, illustrating how technological advancements and regulatory changes can transform entire industries. Additional considerations in market dynamics. Government regulation. Government regulations can profoundly affect market dynamics. They can establish barriers to entry, influence market structure, and guide firm behavior. Regulatory frameworks often aim to promote competition and protect consumers but can also stifle innovation or create monopolistic environments. Mergers and acquisitions. Mergers and acquisitions, M&As, can reshape market dynamics by consolidating market power, potentially leading to higher prices and altered competitive landscapes. While they can create efficiencies and spur innovation, they may also reduce competition and harm consumer interests. Market segmentation. Market segmentation involves dividing a broader market into subsets of consumers with common needs. This strategy allows businesses to tailor their offerings, improving customer satisfaction and maximizing marketing efficiency. The bottom line. Understanding market dynamics involves analyzing the interplay of various economic forces, including supply and demand, competition, technological advances, government regulation, and consumer behavior. By comprehensively analyzing these dynamics, businesses and policymakers can make informed decisions that influence economic development and consumer welfare. As markets are continually evolving, staying abreast of these dynamics is critical for navigating today's complex economic landscape.